Welcome to Global Money Talk, brought to you by SamPro.TV. Greetings to all of our viewers from across the United States, Korea, and around the world. We're coming to you live from the floor of the New York Stock Exchange in New York City, the financial capital of America. I'm your host, Tai Wong, and joining me today is Dan Ha, partner at Karani Asset Management. Welcome, Dan. Good to have you here.
Thank you very much. Thanks for having me, Tai.
Well, it's been a pretty amazing sort of day and change of trading since the election, which thankfully seems we have a result and we don't really have to worry about it too much. But so, tell the Trump victory. How do you see? What does it mean for the equity market?
Sure. So what does it mean? Well, first of all, obviously yesterday we had a change in perception in the market that is evidenced by the fact that the asset prices of various asset classes have all moved a lot. That means that perception has changed. People's expectations have changed, and that makes sense, right? We have a new president. He's going to have a certain set of policies and a certain direction, and therefore the change in perspective or change in perception and expectation clearly makes sense. Having said that, and I won't go into sort of all the details of what those are, right? I think that was well covered by lots of media. But from my standpoint, there's clearly been a change in perception, but I remind folks that there hasn't yet been any changes in reality. And what I mean by that is, as I sit here, to me, the world on November 7th isn't actually all that different from the world on, say, November 4th or November 5th. Yes, there's now more sort of clarity and visibility in what might happen, but none of those things have actually happened yet, right? So right now, from my standpoint, from my firm's standpoint, we're not making, and we haven't made any dramatic changes to the portfolio because, again, fundamentally, nothing has changed yet. If we go deeper into sort of some of the things that may or may not happen, because, during leading up to elections, candidates will talk about lots of different things, whether they actually happen or not. We know that we have to wait and see, right? And it's also going to be a function of who controls the Congress. So there's lots of moving parts. But there are some things that are certainly more likely than not to actually happen, and at least directionally. So for example, tariffs. Tariffs is something that President-elect Trump has obviously talked a lot about. It's one of his strong points. It was his strong points in his campaign. And it's also something that he can do using the executive power, right? So something like tariffs, whether it's I think the proposed number is something like 10% on all imported goods and 60% on all Chinese imported, goods imported from China. Whether that gets down to be, really precisely that, who knows? But at least directionally, I think it's probably fair to expect sort of higher tariffs kind of across the board. Again, directionally, pretty likely to happen in my view. How much? That it's too hard to know because it's also going to have to be strategic. There's going to have to like pick your battles, if you will. What's interesting about tariffs is I still have lots of friends in Asia, and actually yesterday I was getting a lot of texts and observing text exchanges among my friends on, the companies, consulting firms quickly putting out views on what Trump presidency means for various Asian economies and sectors, for instance. Or my friends that are actually in more sort of export-dependent businesses, texting me and actually asking, "Hey Dan, do you think this is actually going to happen?" So I think the expectation is definitely there, not just in the markets, but also in the real economy. And when I received these texts, it certainly wasn't out of sort of any kind of excitement or sort of I mean it was really more out of anxiety and sort of being concerned because obviously they're in Asia and they're going to be the ones sort of negatively impacted by this, right? So that's something I think the world is probably taking pretty seriously. Something like deregulation, which is expected, and we saw a lot of companies that would benefit from that, go up a lot yesterday. So whether it's investment banking firms, because there's now going to be more M&A, less scrutiny on antitrust, possibly, or banks that are generally very heavily regulated. Again, it's too hard. It's not going to be single-handedly his decision, but I do think that sort of overall tone, from the administration on the stance on these things like antitrust and regulation in general, I think definitely matters. So at least again directionally, I think it's probably fair to assume that there will be less regulation, and therefore those industries that are heavily regulated will probably benefit from that. Having said that, some of these other, many of the other sort of promises from the platform, that's kind of hard to know. Like, so if you take big tech, for instance, I think it's fair to say that at least publicly, Donald Trump was quite negative on, or doesn't really like big tech, right? Whether it's Meta or Google. At the same time, yesterday those stocks rallied, and you can never know exactly why stocks went up or down, but a lot of people were saying that it's the expectation that these guys will be able to, they will be less scrutinized, so the likes of Google and Microsoft, these big guys, and also they'll be able to do more accretive acquisitions, buying up smaller competition, which would be good for them. So who knows? Like, on the one hand, I think it's pretty clear that he doesn't really like them. Maybe it's just rhetoric. Maybe in reality he actually likes them. Who knows? But the Vice President-elect J.D. Vance also has voiced concerns over power of the power concentrated in big tech. But then the stocks rallied because the business environment is going to be good for them. Like, it's too hard to know whether the net effect will be a complete wash or a net benefit or a net positive. Another sort of fun example is Tesla, right? Tesla rallied a lot, yet double digits yesterday because of the obvious Elon Musk involvement. But at the same time, we know that Trump will likely have a hard stance against China, and if that relationship if that relationship gets tougher, Elon Musk and Tesla, as an American company, is heavily dependent on China as a market and also as a place of production. So I think it's too early to know whether Trump presidency will be good for Tesla or net positive for Tesla or net negative for Tesla or a complete wash. But at least yesterday, change in perception is what drives stock prices in the near term. And obviously the market saw it as a net positive, which is why it drove up the stock a lot. But in the long run, over the next 6, 12, 18, 24 months and beyond, whether it's a net positive or net negative, I think it's too soon to know.
You make a great point, because we're looking at the stock. The S&P is within sight of 6,000. The Nasdaq, like, we see 20,000 in the Nasdaq, and as you say, the market loves to discount, right. And that's why we are driving. The equity indices are up again today. I wonder how they'll actually close tomorrow. There's going to be at least some profit taking. Right. But could you tell us what you think this means, or this election means, for maybe overseas equities markets?
No. So I think it's a complicated dynamic. It's not just like, you can't just say blanket or general statement whether it's positive or negative for overseas markets. Also, overseas markets is, that's basically all countries, all regions, ex-US. I mean, it's hugely diverse. We're talking about different countries, different industries. So you can't really say it's positive or negative just generally. However, few things I think are true. One, if we're talking about countries or industries that are obviously more manufacturing oriented and therefore more export oriented, U.S. is still a big importer in the world. So if that's the industry that you operate in, obviously your life or your business environment is about to get materially tougher, assuming that Donald Trump comes through with the tariffs. However, if you're in a strategically important industry for the United States, I'm sure that the new administration will find ways to not hit those industries with the tariffs too much, because it's still important to the United States. So I think, politics aside, we've always thought, focusing on strategic industries and long-term growth industries was important to us even before the election. I mean, that'll be important to us always, because at that point you're not really at the mercy of policy shifts. If your business is producing and selling commodities or exporting commodities, or producing toys and importing them or exporting them into the United States, you're really dependent on favorable policies. And that's something that, as an investment proposition, being so dependent on something that you can't control, it was never really attractive to us, no matter how attractively priced, cyclically attractively priced a stock or an industry may be. So I think ever more important, even more important, to be focusing on sort of the strategic importance and the long-term growth prospects, secular growth prospects of an industry, whether that's an overseas market or a domestic market.
So I do actually have a question, and I don't have many of these in my portfolio. I might have a handful, but if American investors invest overseas and they use an ADR, is that is the foreign exchange risk covered in that or not?
Oh, I see. So the foreign exchange risk, is it covered when you buy ADR? The answer is no. So when you buy an ADR, you are exposed to the foreign exchange risk. So it's just like ADRs for our viewers. It's really just a convenient way to buy and sell foreign listed stocks. They're listed. ADRs are traded here, so you trade them as if they're U.S. stocks. But it's really nothing more than that. If you're concerned about the FX risk, what you should do is actually either go out and buy the local shares and hedge the FX risk by buying or by trading the corresponding currency, or you could do that by buying the US ADR equivalent and also then holding a sort of a hedging position or an opposite position in the currency that you're dealing in. The US ADR, for instance, if you buy, if the US ADR and the underlying company, let's say it trades in France, and if the euro moves in your favor, that simply is going to get reflected in the translation price of the ADR and vice versa. So yes, to answer your question, ADR just gives you the exposure, but it does not give you any kind of sort of built-in hedges, if you will.
So maybe it's on a case-by-case basis, but if and when you do invest in foreign equities, do you have a view on, do you have a philosophy on, do I want to cover the foreign exchange risk, or do I want to take on the foreign exchange risk, in part because that risk is, I like that and the stock?
Right. So, it really comes down to what you want, right? So if you want to have that because you have a view about a particular foreign currency, and if you think that currency is going to get stronger against the dollar, and therefore you want to have a long, when you buy the stock, you're long that security or that currency too. So, if you want to have that long exposure because that's your view, by all means, to hold on to it. But if you don't have a view, and if you don't want to take on a view, and just be neutral, then you should hedge it. Lots of investors will buy, lots of global investors, and we trade globally. Lots of global investors will own shares globally and not necessarily hedge the currency. Because if you own diversified enough a portfolio in terms of, not just in terms of names, but also in terms of currency, often over the long run, that sort of naturally sort of nets out the currency effect. But if you have a strong view about a particular currency, and if you want to express that view, by all means. But again, if you don't want to do that, then you have to find a way to get that risk, that exposure out of your portfolio.
Great. That's really helpful, because sometimes I did used to trade foreign exchange years ago, and sometimes there are currencies that are very, very high yielders, and you never think about, when I do an ADR, do I actually have the currency exposure or not?
Yeah.
But let's switch gears a little bit. Recently, let's talk about your recent conversation with Tom Lee of Fundstrat. That video has gotten a lot of views already. So can you tell us some of your takeaways from that conversation?
Would be happy to. That was a very very fun and insightful conversation. I've got lots of takeaways, but the one thing that if I had to choose, he talked quite a bit about the lengthening of the business cycle in the United States, which I thought was an interesting point. So apparently, according to him, between say 1940 and 1990, roughly about 50-year period between 1940 and 1950, recessions were far more common in the U.S. economy. Something like 40% of the time, the U.S. was in a recession, meaning in a 10-year period, 4 of those years you were in a recession on average. That's a lot, right? That's recession happening quite frequently, and that is less so today. And why is that? It's largely because of the mix of the U.S. economy. So the U.S. economy was far more dependent on manufacturing, going back to the 40s, 50s, 60s, and beyond. And services were a much smaller portion of the U.S. economy. But over time, that has changed, as we know, right? And services naturally are less cyclical than manufacturing. Therefore, the analysis or the argument is that, therefore, the U.S. economy should be less cyclical, and we should be seeing less business cycles. That doesn't mean that we won't have business cycles. I think pretty much, you can count on every economy having a business cycle, but the length of the business cycle sort of lengthening out, meaning having recessions being less frequent because of the underlying mix of the U.S. economy, was an interesting, definitely an interesting point that I took away from that conversation. If you think about this sort of in terms of, sometimes as a stock picker, it's easier for me to think about sort of a macro example as, kind of narrow it down to like a specific company example. There are companies that, for instance, start out as a heavily cyclical business, say a manufacturing company that sells you, say, industrial equipment. And over time, that business starts to develop, for instance, services business. It sells you parts, replacement parts, consumable parts. It will go out and do the maintenance for the product. As the company does that, and as the mix of their revenue, of their business, shifts from being purely manufacturing to increasingly more and more services, the cyclicality of that business actually does change structurally over time. And what happens when that happens is margins become far more stable. And because the business is less cyclical and sort of more predictable or more dependable, they also end up being trading at premium or higher multiples, if you will, get better valuation. So the value of the business actually, the present value of the business actually goes up when that happens. So, if I then zoom back out and think about that in the context of the overall U.S. economy, if the U.S. economy has indeed become less cyclical, they're more service-oriented, therefore less cyclical, and the swings, the volatility in the economy is less less violent, if you will, or more muted, that is a good argument for why the U.S. economy and the U.S. stock market that represents the U.S. economy to a large extent should be one less volatile from a boom and bust standpoint, and also more valuable because of the underlying earnings is of higher quality. So I thought that was an interesting takeaway that I could apply in my process.
You know, that's a remarkable insight, actually, because you hear both parties saying we've lost our manufacturing base and we need to bring back manufacturing jobs.
Yeah.
And I really didn't realize it until I watched it that thinking about that, if you have more manufacturing, you're going to have more gyration, sort of the business cycle,
Right.
and that may be sort of an unwelcome effect. I mean,
Right.
I don't think we're going back to to manufacturing in any serious way unless it's very, very high end, but it's something to certainly think about. So if I just follow that a little bit,
Yeah.
so in general, would you say that I guess PEs for manufacturers should probably be a little bit lower than in general for like service providers?
Oh, absolutely, absolutely. I mean, you see that when you peel back, when you look underneath the cover of the stock market, there are definitely different sort of normalized or average PEs, valuation multiples for different sectors, and it could get. I won't go into too much detail because it could get pretty complicated, and it will probably need a lot more time. But a key driver, a key factor in what determines the multiple of a company is that sort of that dependability or that predictability of the future earning stream or the future cash flow stream. So if you're selling toothpaste, that's a pretty dependable business. You can count on toothpaste sales this year, next year, 5 years from now, even 10 years from now, falling within a pretty narrow range of possible outcomes. If you're selling agricultural equipment, depending on where you are in the ag cycle 5, 10 years from now, the outcome the outcome could be very different. So the narrower the range of potential outcomes, another way to say that is the more predictable the business and the more dependable the forecast. A company like that will certainly trade, all else being equal, at a higher multiple than a company that has got a far more cyclical cash flow stream out into the future.
I want to hear more about what you think about Tommy. I just want to go down the rabbit hole a little bit here.
Yeah.
When we have really long business cycles, there's an argument that goes that if you have boom busts are important because the busts sort of clear out the weakest companies, clears out the dead wood, and makes the overall sort of economy stronger. Do you think that is there any impact from having really long sort of expansions? And I think Tom argued that we've had an expansion since really if you don't count COVID, we've had an expansion really since 2009. Is that too long? Do we need the occasional recession to just clear out some of this dead wood or not?
Right. So Tom and I talked about that, actually specifically about that, when I pointed out that we didn't have a big recession, a broad-based recession in a while. Again, depending on how you count the 2020 COVID recession, but there have been pockets of recessions, sector-specific, industry-specific recession. So Tom's point about that was, and when I asked Tom, like, is this it? Like, in other words, if you're waiting for that big recession to drop that really takes the whole country down, should you continue to wait for that? Or have we gotten enough recessions in various pockets of the economy, just not one really massive one? And his view was, I think it's fair to say that his answer was basically yes. You're right, cycles are necessary to sometimes clear out, sort of clean house, if you will, within the economy. But nothing says that it has to happen for the entire economy. Like, the rest of the economy could be doing well, but the startup sector, the industry, might go through its own boom and bust cycle, even though the overall economy might be doing well. Something like that could happen for durable goods, autos, for instance. It could have its own boom and bust cycle, but doesn't really bring down the entire economy. I actually don't see how that is negative, as long as there is that sort of micro, sort of more contained business cycles that sort of clear out some of the excesses that inevitably get built up in those particular pockets of the economy. But I don't see how it's a bad thing that a sector or an industry doesn't really bring down the entire economy. Like how the financials did during the Great Financial Crisis, or how the tech sector did during the .com. So I think that's a pretty healthy dynamic, and I'd be supportive of that.
Last time you were on the show,
yeah,
you talked about concentration in the market. Tom Lee spoke about that, and he wasn't really worried about that. So, what are your thoughts on what Tom had to say?
Yeah, no, that was a fun conversation too. I actually brought some slides to talk about this. Can we bring up slide number 1? So he shared his views both on the level of multiple, the PE multiple, or more specifically, we were talking about the CAPE, which is the cyclically adjusted PE. And we also talked about the concentration a bit. And if you remember the appearance that I made last week, or no, I think it may have been 2 weeks ago, I talked about Goldman Sachs' forecast that the next 10 years, the return for the S&P 500 might end up being just something like 3% per annum, which is a very, very low return, sort of an unacceptable level of return for equities. And the two main reasons that the report cited was the really high elevated valuation levels and really high concentration levels. And the combination of those two, not very good. Tom wasn't sold on the idea that high PE, and particularly high CAPE, cyclically adjusted PE, was really an indication of, was really a bullish, bearish signal necessarily. I agree with him to the extent that PEs in and of itself, multiple valuation multiples in and of themselves, you can't rely on them to tell you whether you should be buying or selling stocks. The chart that I brought here, this goes back to, I think, the 1920s, and it looks at the 10-year total returns of the S&P 500 of various periods versus the starting PE of the S&P 500. So, the intuition, the conventional wisdom would be that, if you're starting with a high PE, then you're starting at a high valuation. Therefore, your returns over the next 10 years should be pretty poor. And if you're starting with a low PE, your returns over the next 10 years should be pretty good because you're buying cheaply. Well, there is some truth to that, but if you look at this chart, what this says is on the x-axis is the starting PE of the various periods, and on the y-axis is the following 10-year returns annualized, total return for the S&P 500. And you can see that there is a downward sloping relationship, meaning if you pay a high price, there is a good chance that your returns over the next 10 years is going to be pretty low because you bought expensively and vice versa. But what the R-squared of 0.43 means is that the PE, the starting PE, only explains about 43% of the returns of the following 10 years, meaning there's more than 50% of the returns of the S&P 500 forward returns is explained by something else, meaning that it's not just PE alone, and it's not even majority PE. it's a combination of various things that really drive the S&P 500 return. So we all wish that it'd be as easy as just, oh, high PE, sell stocks, low PE, buy stocks. But what this shows is that it's not that simple. PE plays an important role, but there's all kinds of other things, earnings growth, inflation, interest rate environment, all kinds of other factors that really determine the return of the S&P 500. Now, therefore, PE isn't the only thing, but it is an important part of, or important determinant of your future returns. So I still think you do have to worry about the current levels of PE. On concentration, we actually didn't get to spend that much time on it. I wish we did, and perhaps I'll get a chance to talk to him about it more in the future. If we could actually pull up slide number 2, I brought some slides about the concentration. So this is from the Goldman report. The 10 largest companies in the S&P 500 currently, or as of pretty recently, represents 36% of the market cap of the S&P 500. That's the highest level since going back to the 1980s, and it rivals some of the really peak points going back in history. If we could actually go to the next slide, please, slide 3. Now, anyone looking at the concentration of the S&P 500 might point to these individual countries and say, well, 36% is actually not that high because there are these other developed economies where the concentration of the top 10 is even greater. So you see that this is a report from, this is actually misstated. It's not from Goldman Sachs. It's from Morgan Stanley. So I do want to give proper credit. So, Switzerland, France, Australia, Germany, their concentration of the top 10 of the overall, of their entire market cap is actually even higher. So you might say, okay, the concentration level of the United States, top 10 representing 36% of the S&P 500. And here, if you look here, it's actually top 10 of the entire U.S. Market cap. So the percentage is actually a little lower. And this also was in 2023, so it needs to be updated. But you might look at this and say, okay, the concentration level in the United States is actually not that bad. However, if we go to the next slide, slide number 4, I think it's fair to look at, for instance, US or Europe as a whole, not just in terms of individual companies. Can we get slide number 4, please? If you just assume that Western Europe is just one big collective economy, kind of like the United States, if you will, if you take the top 10 most valuable companies in Western Europe and compare that against the aggregate market cap of the top 500 countries or companies in all of Western Europe, it's actually 2.7 trillion out of about 15 trillion, which means it represents about 18%. So 18%, if we consider, again, the Western Europe as a single giant economy and a giant single market, the top 10 represents, the concentration is about half. So for the United States, it was 36%, right? Top 10 is 36% of the top 500 companies. In Europe, top 10 represents 18% of the top 500 companies. So if we look at it this way, the concentration level in the United States is actually quite high. And why does concentration matter so much? If we go to slide number 5, concentration historically has had a pretty notable relationship with the S&P returns. This is a chart from Morgan Stanley, and this shows you that during the period of rising concentration within the S&P 500, you can see that the annualized returns are much stronger. So the period 16.4, 23.5, 12%. These are certainly higher levels of returns And 10.5 is still a pretty solid return, but it's certainly weaker than 16 or 23 or 12. And there was also even a period of 3.6% return. This is from the early 2000s to the 2010s. So concentration, the rising and falling concentration of the market definitely does, at least historically, has relationship with the return levels of the S&P 500, which is why it's something that a lot of people, including us, are paying close attention to.
Now, that's a really remarkable chart, the last one that you show. And it seems to suggest that if there is high concentration, does it suggest that there's sort of leadership in certain sectors of the economy that drive that concentration, that make the return so much better? Because it almost seems counterintuitive, right? If concentration is very high, all your eggs in one basket, like Switzerland that you saw earlier, it seems risky, but actually your last chart suggests the opposite almost.
Well, as the concentration builds up, so returns are strong, and when that happens, concentration usually builds up. Why is that? Because what leads to strong economies, one of the characteristics of, or sort of leading up to a peak, and I wouldn't say necessarily bubble, but just peaks in markets, is usually things that have been working well, things that have been going up a lot. You start seeing more and more money pile into those names, and so the winners continue to win, and they end up becoming larger and larger part of the index. And the environment that allows that to happen is usually a bullish environment where things are going up, and the bigger things are going up even more. So naturally, when in an environment that yields very strong equity returns, concentration usually builds up together. And when that unwinds, returns are weaker, and concentration the market actually broadens out, because those names that really drove the returns by becoming more and more concentrated, usually that unwinds. Which is why when the market gets narrower and narrower and concentration gets built up, that's, many sort of see that as sort of a cautionary sign. And interesting, you point that out. Yesterday, an interview of Stan Druckenmiller was published yesterday, and I watched it. He mentioned concentration as definitely being something to watch and something to be concerned about. But he said that from his standpoint, right now the level of concentration is really more sort of signaling yellow light than red light. So he wasn't really saying that it's gotten to be really, really dangerous levels, but nonetheless, it's pretty high.
Right. So, Tom Lee did say, and I want to get to it before the end of the show, he mentioned demographics as being really important to market direction over time. Can you talk a little bit more about that?
I'll quickly just talk about that, which I thought was a really interesting insight too. So he talked about demographics, and by the way, I encourage everyone watching this to, and if they haven't already, go watch the full interview with Tom Lee, because it's really worth watching and hearing from him, not from me. But demographics is one of the key sort of first principles that the firm uses in trying to think about the markets and trying to predict the direction of the market. And their work suggests that stock returns long term really follows demographics closely. And the age cohort that they pay attention to the most is the 30 to 50 year olds. And what happens to the population of the 30 to 50 year olds historically has been a good indicator of where the stock market is headed over time. And so, he talked about how the firm got bullish, in the after the financial crisis, because that's when the population of the 30 to 50 year olds actually bottomed and started to expand. This age cohort the population sometimes is large, sometimes it expands, sometimes it shrinks, depending on what happened to birth rates prior to that, right? And that age cohort bottomed around that time frame and has been expanding. Right now, the 30 to 50-year-old cohort is really dominated by the millennials, right? And the millennials currently, the oldest millennial is 43, but the average millennial is probably in their early 30s. Millennials currently at something like 72, 73 million is the largest cohort within the entire U.S. population. And so the largest cohort is actually also in that prime sort of 30 to 50
consumption period.
Right,
yeah.
consumption period. Therefore, and he doesn't, and that cohort, the millennial cohort, won't peak until something like 2038. So, if you actually follow the demographic trends like Tom Lee and Funstrat do, then you can use that as a measure to see how long sort of the bullish run could last for U.S. equities. Obviously, there will be cycles within, so you have to pay attention to that. But that is a strong long-term demographic trend that his firm is paying attention to.
Those are great insights, and
Yeah.
I would say definitely watch Tom Lee's interview with Dan on that. Thank you very much, Dan. And that will do it for Global Money Talk, live from the New York Stock Exchange. We're so excited to bring you daily coverage here on SamPro.TV. You can check out the show anytime on our YouTube channel by searching Global Money Talk. Thanks so much for joining us, and we'll be back here tomorrow. Have a great day.